Okay, so what I basically cover in these sections, okay, it has been a tendency since almost every attempt that I am conducting this webinar. Now, what basically is the purpose of this webinar, specifically talking about FM financial management exam? Okay. Now, in financial management exam, students always communicate with me as I am dealing with students from approximately 65 plus countries around the world. So I always, we teach many students from different countries and stuff like that. So everybody has the same argument, either it's from Pakistan, we have many students from India, Middle Eastern markets, UK, European markets. So we have many students from Nepal. So everyone has a single 1 point problem, specifically talking about FM financial management exam. That students tell me that as far as my preparation is concerned, I feel myself quite confident as far as section C questions are concerned, the 2020 mark questions. Okay. But they tell me that we are struggling in MCQs and MTQs. Okay. Now, I am not a tutor who will say to the students that, okay, your concern is invalid and you are not well prepared. That's why you are struggling in MCQs and MTQs. Okay. The thing is that this concern that I have some problem in MCQs and MTQs, this concern is a very valid and very genuine concern as far as students are concerned. Why? According to the students, the issue is that, and why I'm saying that the concern of students is very genuine, that what you all do is that to prepare the past exam questions, in the end, obviously, when you are preparing for the exam, you do maximum past paper questions, right? Now, when you go and see the past paper questions, you always find one thing, that in past paper questions, now this is not about just one student, it's every student, that before the exam they try to attempt as many past exam questions as they can. Now, when you go and attempt the past exam questions on ACCA website, you see that ACCA publishes only the section C questions. Very rarely, 90% times no, and 10% times rarely it publishes some MCQs and MTQs. So when you are doing the section C questions, you know the clear-cut idea what examiner wants, what examiner is asking. Okay. But when you don't have any idea about what examiner is asking in MCQs and MTQs, so when you are not sure that examiner is what asking in MCQs and MTQs because they are not publishing, you are not prepared for that, what examiner is asking. We don't have past papers. You don't have past papers. We don't know how examiner is asking the MCQs, MTQs. We know how he's asking section C questions. That's why we do perform them well. But we don't know how MCQs and MTQs are coming. Resultantly, you have to rely on BPP or Kaplan kits for MCQs and MTQs. And many students have given exams. The level of questions and MCQs which come in the exam and what are provided in BPP and Kaplan, they are sometimes not close to each other, resulting in students very much struggling in MCQs and MTQs. So what we do is, before every attempt, we conduct this session and we solve 10 to 15 MCQs which are close to your exam, what your examiner wants. How do we know this is what examiner wants? This is my research. Okay. So from the last 7 attempts, I am conducting this webinar. Okay, this is the 7th video of MCQ session which I am conducting, and in this video also I will be solving 15 MCQs which are close to the exam. Okay, and the previous 6 session videos which I have covered for MCQs, those 6 MCQ videos are currently available on my YouTube channel for those students who have not studied from me. Those who have studied from me, obviously those MCQ videos are available on our LMS portal. But those who haven't studied from me, those MCQ videos are available for you, the 6 MCQ videos. They're available for you on my YouTube channel. Okay. So I will also share the link of that YouTube channel on the WhatsApp group, mate. I strongly advise you that after today's session, there will be 7 videos of MCQs in total. And in every video, we cover 15 MCQs approximately. So 15 into 7, that's 105 MCQs close to the exam, which come up similar nature in the exam. So I strongly suggest all of you to watch all those 7 videos, including this. And when you will go in the exam, you will see that how good you perform in MCQs and MTQs after taking those 7 videos. Okay. So in today's class, we will be also doing those an MCQ, 15 MCQs. Okay. So let's start with the first MCQ that's on your screen. The question states the home currency of Acca is the dollar, and it trades with a company in a foreign country whose home currency is the dinar. Okay. So the question states that the home currency of Acca is dollar. Okay. And it trades with a company in foreign country whose currency is the dinar. So foreign country currency is the dinar. The following information is available. Look at the information. Spot rate is 20 dinars per dollar. Dinar is coming in numerator and dollar is coming in denominator. Okay. Interest rates of both countries are given. Home country, that's dollar, and foreign country, that's dinar. And inflation rate is also given. Home country, that's dollar, and foreign country, that's dinar. What is the 6-month forward exchange rate? Now we all know that in order to compute forward rate, we have 2 approaches. One is called purchasing power parity theory. Okay. And the other is called interest rate parity. Okay. When the question is asking for forward rate, as you all know that for forward rate, we have 2 approaches: purchasing power parity, interest rate parity. Purchasing power parity states that you need to use inflation rates when computing forward rates. Okay. And it computes forward rate by a formula. Spot rate calls it S naught into 1 plus HC over 1 plus HB. Okay. And the other is called interest rate parity theory. This computes forward rates through interest rates. And this states that forward rate will be the spot rate S naught or F naught into 1 plus IC over 1 plus IB. The only difference between these 2 theories is that both compute forward rate, but one uses inflation rates to compute forward rates and one uses interest rates. So in purchasing power parity, HC and HB are the inflation rates of both countries. And in interest rate parity, the IC and IB are interest rates of both countries. So both have the same formula, both use the same concept that they compute forward rate through this approach, but one uses inflation rates of both countries, that's CHB, and the other uses interest rates. Okay. So in this question, I am asked forward rate, 6-month forward exchange rate. So I will obviously apply purchasing power parity or interest rate parity. Now, sometimes only inflation rates are given. So students are easily apply purchasing power parity. Sometimes interest rates are given, they apply interest rate parity. Here, both are given. And it's not mentioning you should find forward rate through which approach. So there is an examiner instruction here. If nothing is mentioned and both rates are given, interest rates and inflation rate, you should always use interest rates to compute future rates. Okay. So I will compute forward rate through interest rate parity theory. This is S naught into 1 plus IC over 1 plus IB. Okay. So S naught is the current spot rate. What is the current spot rate? 20 dinars per dollar. This is the current spot rate, 20 dinars per dollar. Okay. Multiply by 1 plus interest rate of country 1, IC, over 1 plus IB, interest rate of country 2. As you have studied from me, those who have studied from me, they know This question is not about quotes. That quotes are applied in payments and receipts. This question in purchasing power parity theory, interest rate parity theory, which interest rate should come in IC and which should in IB? I have told you that the currency which is in numerator, that interest rate or inflation rate will come in numerator, and which currency is in denominator, that interest rate and inflation rate will come in denominator. So if you can see the spot rate, it's 20 dinars per dollar. Dinar is in numerator. So interest rate or inflation rate of dinar will come in numerator. What is the dinar inflation or interest rate you're using interest rate? It's 7% per year. If you will take 7% per year, it will give you 1 year forward rate because you are taking per year. You need 6 month forward rate, so take 6 month rate. So 7% per year means for 6 months it's going to be 3.5% over 1 plus IB. Denominator comes interest rate or inflation rate of other country. Since dollar per dollar is in denominator, we will take the dollar rate. So dollar rate, home country rate, interest rate is 3%. So for 6 months, we will take 1.5%. Okay, 20 into 1 plus 3.5% over 1 plus 1.5%. This gives 20.39. Okay, quickly noted so we can move forward then. I have to do 15 MCQs, so I cannot comment on how long the class will take. But if anyone has some commitments, I will share the recording after the. And we are taking interest rate. Since it's 6 month forward rate, we are taking 6 months rate. The numerator, that rate will come whose currency is in the numerator and spot rate. So in spot rate, 20 dinar per dollar. Dinar is in numerator, take its interest rate in numerator. Dollar is in denominator, take its interest rate in denominator. This Rabbani Walker, this might be a problem at your end because if a problem is at my end, everybody suffers. But since it's at your end, only you are suffering. Thank you. Now, second, the following information relates to an investment project. You are given present value of sales revenue, present value of variable cost, present value of contribution, present value of fixed cost, present value of operating income, initial investment, and NPV. What is the sensitivity of NPV to a change in sales volume? It's asking sensitivity analysis on sales volume. Now, sensitivity analysis is a very easy topic. If the question asks sensitivity analysis on selling price, the formula is NPV over present value of sales. Okay. If it asks sensitivity analysis on variable cost, NPV over present value of variable cost. If it asks sensitivity analysis on fixed cost, NPV over present value of fixed cost. If it asks sensitivity analysis on investment, NPV over investment. So whatever topic sensitivity can be asked, I have written the formulas with you in my classes for those students who have studied from me, that whenever sensitivity is required of any variable, NPV over that variable. So sensitivity analysis on sales, NPV over present value of sales. Sensitivity analysis on variable cost, NPV over present value of variable cost. Sensitivity analysis on fixed cost, NPV over present value of fixed cost. And I told you when question asks sensitivity analysis on sales volume. So sensitivity analysis on sales volume is, I have told you the formula. I have taught you the formula, NPV over present value of what? Anyone remembers? Contribution. So I will simply take it here. NPV over present value of contribution. So we all know NPV is 1300 over present value of contribution. What is the present value of contribution? It's given 24550. Do this NPV 1300 over present value of contribution 24550. 1300 over 24550, 5.3%. Okay. because it didn't ask sensitivity analysis on sales. This is taken when it asks and sensitivity analysis on sales. It didn't ask sales. So why will we take sales? It asks volume. We take contribution in that. Okay. Now there is a question that Gurdeep plots the historic movements of share prices and uses this analysis to make her investment decisions. There is some company called Gurdeep. It plots the historic movements of share prices and uses this analysis to make investment decisions. Oliver believes share prices reflect all information at all times. There are two parties given, Gurdeep, Oliver. Gurdeep plots the historic movements, okay, of share prices and uses this analysis to make investment decisions. Okay. And secondly, Oliver believes share price reflects all information at all times. Match the level of capital markets efficiency that best reflects each of Gurdeep and Oliver's beliefs. So name is Gurdeep and Oliver. Okay. Match the level of capital markets efficiency that best reflects Gurdeep and Oliver's beliefs. So efficiency can be weak form, strong form, semi-strong form, or no efficiency. Okay, so we have to match what does Gurdeep belief mean and what does Oliver's belief means. Gurdeep, what does Gurdeep do? It plots the historic movement of share prices and uses this to make investment decisions. Oliver believes share price reflect all information, everything at all times. An easy thing is that since Oliver thinks that share price include all information every time, past, public, insider, everything. So Oliver's beliefs may be strong form. Right? Oliver's beliefs may be strong form. In markets, you have studied, and specifically we discussed this in business valuation, that there are three forms of efficiency: weak form, semi-strong form, strong form. Okay. So Oliver believes that share prices reflect all information at all times, past, public, insider, share price, everything. This is the concept of strong form, that share prices include all information. Okay. Gurdeep plots the historic movements of share prices and uses this analysis to make her investment decisions. Now, Gurdeep plots historic movement of share prices and uses this to make investment decisions. Was there any weak form or strong form efficiency which tells us that you should plot historic movements of share prices and use this to make investment decision? No. So according to Gurdeep, the markets are not efficient. Now, there is a trap in this. There are many students, including my students, who might be wondering that Gurdeep is weak form. Okay, because semi-strong form doesn't come here. Semi-strong form believes that share prices reflect past information and publicly available information. I have taught you three efficiencies, right? Weak form, which states share prices reflect past information. Semi-strong form, share prices reflect past as well as public, and strong form, share prices reflect all things, past, public, and insider. So Oliver believes share prices reflect all information. This is strong form, that it includes everything, past, public, insider. Now, had it been written that Gurdeep believes share prices reflect past information, then it's weak form. Had it been written Gurdeep believes that share prices reflect past and public, then it's semi-strong form. If it's written Gurdeep believes that share prices include everything, then it's strong form. It's not written that Gurdeep believes that share prices reflect past information. Then I would have said weak form. It's written Gurdeep plots the historic movements of share price and uses this analysis to make investment decision. Gurdeep has no belief that share prices reflect past or publicly available information or insider information. So since Gurdeep is not believing that share prices have past, public or insider anything, he's just plotting and making investment decision. He's not believing anything. So that means he believes in no efficiency. So the correct answer you should match is Gurdeep, no efficiency, and Oliver, strong form efficiency. Okay. Sharbano, in any efficiency, we don't plot anything. Weak form, semi-strong form, and strong form is just a belief. That weak form is a belief that share prices include past information, and semi-strong form is a belief it includes two things, and strong form is a belief it includes three things. In no efficiency, we plot anything and make investment decisions. So if he's doing that, he's not believing in an efficiency. Question number 4, I found a very easy MCQ. Which of the following statements concerning capital structure theory is correct? Now, which statement regarding capital structure theory is correct? Okay. Remember that capital structure theories, which I taught you, traditional theory, Modigliani Miller, no tax theory, with tax theory, pecking order theory. Remember in capital structure theories, WAC, I taught you this. Traditional theory of WAC, Modigliani Miller, no tax, with tax, pecking order. So which statement is correct? Okay. In traditional theory, there is a linear relationship between cost of equity and financial risk. Okay. This is wrong because traditional theory doesn't say this, that there is always a linear relation between cost of equity and financial risk. What does traditional theory told you? Traditional theory told you that when you introduce debt, financial risk, gearing remains there. Okay. When you introduce debt, gearing rises, financial risk rises, but KE doesn't rises. That's linear relation, that one is rising, other is also rising. Okay. Traditional theory didn't taught you this. Traditional theory taught you that when debt is introduced, gearing increases, financial risk increases, the KE remains same. When you increase further debt, further financial risk increases, KE remains same. After some time, when there is too much debt, financial risk goes too up, then equity holders demand increased return, and then KE rises. So there is not a linear relation. So in traditional theory, there is a linear relation between KE and risk, that as soon as you introduce debt, risk increases and KE increases. This doesn't happen. So this statement is wrong. Modigliani and Miller said that in the absence of tax, KE would remain constant. This is also wrong. Modigliani and Miller didn't say this, that KE would remain constant. Remember Modigliani and Miller, when debt is introduced, WACC falls and KE rises so that it gets offsets. Remember Modigliani and Miller, when you introduce debt, gearing increases, risk increases, WACC falls, but KE rises to offset it. It is saying that KE remains constant. This is also wrong. Modigliani and Miller didn't say KE remains constant. Third, pecking order theory indicates that preference shares are preferred to debt. This is also wrong. Pecking order theory didn't say that preference shares are preferred over debt. Remember pecking order theory, I told you preference. First debt, then equity. First retained earnings, then debt, then equity. So pecking order theory states that shares should be preferred over debt. That's wrong. Debt would be preferred. Retained earnings, then debt, then equity. This is also wrong. So fourth automatically remains the correct one. Business risk is assumed to be constant as capital structure changes. When there is change in capital structure, you introduce debt or equity. It only impacts financial risk, right? Debt introduction is only financial risk, gearing risk. Business risk remains constant. That's what is taught in WAC, that whenever you introduce debt, your gearing, financial risk is affected. The business risk remains same. So this was a very good question, specifically for those who have a good understanding of capital structure theories. That would have been easy. That in traditional view, there is a linear relationship between KE and financial risk. Financial risk is gearing. This is wrong. When in traditional theory, you were taught you introduce debt, the risk increases, KE remains same. More debt, more risk increases, KE remains same. Only after a while, KE rises. So there is no linear relation. Modigliani and Miller says in the absence of tax, KE would remain constant. Modigliani and Miller's no theory states that KE remains constant. It states when you introduce debt, KE rises. Okay. Pecking order theory states that shares are preferred. No, that is preferred. This is also wrong. So the correct answer is the fourth one. Minal, in pecking order theory, preference shares are preferred is wrong. We prefer debt over equity. We don't prefer preference shares. So again, repeating, which action is least likely to increase shareholder wealth? The WACC is decreased. When weighted average cost of capital decreases, that's written in your text that when WACC goes down, the market value, share price goes up. So this will increase shareholder wealth because shareholder wealth only increases when share price increases. So when WACC goes down, the share price increases, this will increase shareholder wealth. Option C, the board of directors invest in a project with positive NPV. Whenever you invest in a positive NPV project, your share prices go up. That, okay, this company is investing in positive NPV project. The share price goes up, wealth increases. The annual report declares full compliance with corporate governance codes. When your annual report declares that you have complied with laws and regulations, your prices go up. This increases shareholder wealth. Financial rewards of directors are linked to increase EPS. So rewards of directors are linked to EPS. This will increase directors' rewards because we have linked their rewards with EPS. So directors' rewards will increase. This won't likely to increase share price. So this is the least likely option. Now, some people may argue that option B can also be an indirect impact, that when rewards of directors are linked to share price, they will work hard, they will get motivated, this will increase share price and wealth. That's indirect. So this is least likely. Okay. Okay, now this MCQ is from the initial chapters, macroeconomics related financial management function. Which two of the following statements are features of money market instruments? Okay, which two of the following statements are features of money market instruments? You can just go and open the Kaplan text and you can see that it's clearly mentioned features of money market instruments. Okay, a negotiable instrument can be sold before maturity. The yield on commercial paper is lower than on treasury bills. Treasury bills means government bonds. Discount instruments trade at less than face value. And commercial paper is often used by companies to fund long-term expenditure. So which two statements are of money market instruments? Now, a negotiable instrument can be sold before maturity. This seems correct because why it's a negotiable instrument? Negotiable means it can be negotiated, and when it can be negotiated, it can be sold before maturity because the name negotiable. Negotiable means you can negotiate. So when something is negotiable, it can be sold anytime before maturity or at maturity. So this seems correct. The yield on commercial paper is lower than on treasury bills, government bonds. This is an absolutely wrong statement. Always remember, I have taught you this myself, the yield on government bonds is the lowest because they are risk-free. The yield on government bonds is the lowest. Treasury bills have the lowest yield because they are risk-free. Okay. So treasury bills, government stock return yield is the lowest because they are the lowest risk and the others have higher. So it is saying that yield on commercial paper is lower than treasury bills. This is wrong. The yield on treasury bills is the lowest, not on paper is the lowest. Discount instruments trade at less than face value. This is correct because if any instrument is discounted means it's trading at less than its original value, right? If any instrument is discounted instrument, it's trading at less than value. And commercial paper is often used by companies to fund long-term expenditure. This is wrong. Commercial paper is usually used for short-term expenditure. Okay. So negotiable instrument can be sold before maturity. Obviously, it's negotiable. It can be negotiated and sold. Discount instruments trade at less than value. That's why they are called discount instruments. Yield on commercial paper is lower than treasury bills. It's wrong. The lowest yield is on treasury bills. Okay, so very easy question. The following are extracts from the statement of profit and loss of Gohar company. Okay. Sales, cost of sales, PBIT, interest, PBT, tax, PAT. 60% of cost of sales is variable. That means cost of sales is 50,000. So 60% is variable. That means variable is 30,000. So if the question is saying 60% of cost of sales is variable, that means 50,000 into 60%, the variable cost of sales is 30,000. Okay. What is the operational gearing? As you all know that we have taught you the formula of operational gearing as a contribution over PBIT. Okay. So contribution is sales 60,000 less variable only 30,000. So the contribution is 30,000 over PBIT is how much? 10,000. Okay. So 30,000 over 10,000 makes it 3 times. Okay. Okay. The management of Lamara company has annual credit sales of 20 million and receivables of 4 million. Okay. This has been told to you multiple times in the classes that whenever question gives you credit sales, and receivables 4 million. I have always instructed you to find receivable days. Remember our working capital classes that whenever question gives credit sales and receivables, always find receivable days. Okay. Receivables 4, our credit sales 20 into 365. Okay. So 4 over 20 into 365 makes it 73 days. I have not read the question completely, but this is my instruction to all of you. I have taught this in working capital as well, that whenever question gives you credit sales and receivables, always find receivable days. Okay, so 20 million credit sales and receivables 4 million, I immediately found receivable days. Working capital is financed at 12% interest per year, assume 365 days in a year. Calculate the annual finance cost saving if management reduces the collection period to 60 days. Now, what is the current collection period? It's 73 days. Calculate the finance cost saving. Finance cost saving means reduction in finance cost. Finance cost saving means reduction in finance cost if collection period is reduced to 60 days. This is a topic of remember that something called early payment period or early payment discount or early settlement discount, that whenever you offer someone to pay early rather than 73 days, the collection period is 60 days. So whenever someone pays early, your finance cost falls. So that's it is asking that what is the finance cost saving, not the total cost saving, just the finance cost saving if collection period is reduced to 60 days from 73 days. I have taught you how to find the increase in finance cost and decrease in finance cost. Remember, increase or decrease in finance cost was computed as existing and new. So simply compute existing finance cost and new finance cost, you will get your answer. What is the existing finance cost? Okay. How much amount got stuck initially? 20 million. Okay. How much amount got stuck initially? 20 million. You made credit sales of 20 million, right? So 20 million got stuck. From where did you finance it? Overdraft, 12%. And existing for how many days? 73 divided by 365. So what is the existing finance cost? 20 million into 12% into 73 divided by 365. 0.48 million. 480,000. If collection period is reduced to 60 days, how much credit sales you are making? Did it say that it has impacted credit sales? No. So that means it hasn't impacted credit sales. You are still making credit sales of 20 million. So blocked cash is 20 million. You will again raise it through overdraft. At what rate? 12%. But now you need finance for how many days? 60 days. So what is the new finance cost? 394,520. So what is the reduction in finance cost? 85,500 approximately. Okay, so identify by clicking on the relevant box whether each of the following statements concerning financial management is true or false. So which statements are true and which are false concerning financial management? It is asking identify by clicking on the relevant box whether each of the following statements concerning financial management is true or false. So concerning financial management is true or false. Okay, I will get back to the question. Please don't bug again and again. I will get back to your question. Okay. So identify by clicking on the relevant box whether each of the following statement concerning financial management is true or false. It is concerned with investment decision, financing decision, and dividend decision. This statement is true because this is my first class of F9, right? Those who have taken it from me, this is my first class of financial management. That financial management is dealing with investment decision, financing decision, dividend decision. So this is true. It is concerned with financial planning and financial control. True. This is also, I wrote you in the class that it deals with planning as well as control, decision making. Okay. It considers the management of risk. True, because that's why you're studying risk management here, because it manages risk. It is concerned with providing information about past plans and decisions. False. Financial management's decisions are investment decisions. Investment decisions, future investments. Financing decisions, from where to raise finance, future. Dividend decision, how much dividend we should pay, future. It never deals in past. In past, you know which subject deals, financial reporting, your FR paper. Financial management doesn't deal in past decisions. It deals with investment decision. That's future investment decision. Financing, from where we should raise finance in the future, and dividend, whether we should pay dividend in future. So this is the correct answer. Okay, one student is asking that what does rounding to the nearest dollar mean? So this is a debatable and long issue that nearest thousand means something else, nearest dollar means something else. So it's better you contact me after the class on WhatsApp. I will help you. Okay. Okay, now another very easy question. Scava has paid the following dividends per share in recent years for 2004, 3, 2, 1. Dividends are given. It has paid the following dividend. That means past dividend is given. Dividend for 2004 has just been paid. Scava has a KE of 12%. KE is given. Using historic growth rate and dividend growth model, what is the price of share on ex-dividend basis? So you need to find market price of share using DVM. Now, I have taught you that market price of share using DVM has two formulas. Remember, this is business valuation. Market price of share using DVM has two formulas. If past dividends are given, we apply the formula P naught is equals to D1 upon K minus G. And if future dividends are given, we take present value of future dividend discounted at K. So you have studied both. One was in correct company question where future dividends were given, others were past dividends. So whenever someone asks you to find market price of share price using DVM, so if future dividends are given, present value of all future dividends. If past dividends are given, P naught is equal to D1 upon K minus G. Here you can see past dividends are given. So you will apply the formula P naught is equals to D1 upon KE minus G. Okay. Now you need G. So for G, you know, Gordon's retention or past dividend. Here past dividends are given, we will take past dividend model. So latest dividend 0.360 upon earliest dividend 0.311 power 1 upon n. That means 1 upon, in 4 years n would be 3 minus 1. So let's see what growth rate we get. 5%. Okay, growth rate is 5%. And once you get growth rate, you will easily get D1, next year's dividend. What is the latest dividend? 0.360. It's increasing by 5%. So increase it by 5% to get next year dividend. .378. And now find share price. P naught is equals to D1 0.378 upon KE 12% minus G 5%. Okay. 5.4. Okay. Next question. There is a risk that value of our foreign currency denominated assets and liabilities will change when we prepare accounts. There is a risk that the value of our foreign currency denominated assets and liabilities will change when we prepare our accounts. To which risk does the above statement refer? Translation, economic, transaction, interest rate. I have taught you translation risk, economic risk, transaction risk, interest rate risk. There is a risk that value of foreign currency assets liabilities will change when we prepare our accounts. Account means financial statements. So risk that value of our foreign currency denominated assets and liabilities will change when we prepare financial statements. Did I tell you that transaction risk occurs at the time of preparation of financial statements? No, it's just due to a transaction buying, selling. Economic risk, both. But remember, in translation risk, I told you that when you translate financial statements, then this risk occurs. So whenever risk is there when preparing financial statements, that's always a translation risk. Remember, transaction risk is a risk of buying, selling. Economic risk, both. Interest rate risk, that interest rates go up. When assets and liabilities are changing in our financial statements, that's translation risk. In following information has been calculated: receivable collection period, raw material inventory turnover period, work in progress period, trade payables payment period, and finished goods inventory turnover period is given. Length of working capital cycle. Now, working capital cycle is basically cash operating cycle, right? Working capital cycle is basically cash operating cycle. So working capital cycle is basically cash operating cycle. So it's asking cash operating cycle. I taught you cash operating cycle for two organizations, a retail business and a manufacturing business. For a manufacturing business, it's just inventory days plus receivable days minus payable days. But for a manufacturing business, retail business is inventory days plus receivable days minus payable days. But for a manufacturing business, remember, raw material stock holding period plus WIP period plus finished goods stock holding period plus debtor collection period minus creditor payment period. So if you want to find cash operating cycle here, raw material stock holding period is 42 days plus WIP period, the time in production, that's 30 days, plus finished goods stock holding period, how long we keep finished goods in stores, that's 45 days, plus debtor collection period, that's 52 days, how long receivables take to pay. So if you see that raw material turnover period is 42 days, for 42 days, raw materials are in stores. WIP period 30 days, making takes 30 days, 72. 45 days to sell, 72 and 45, 117. 52 days to receive payment, 169 days, you are getting payment. And you have to pay payables in 66 days, okay? So just calculate them. This makes it 103 days. Which of the following are usually seen as benefits of financial intermediation? Now, who is a financial intermediary? The middle party. You involve a middle party in transaction. Okay. So which are benefits of middle party? Interest rate fixing, risk sharing, and maturity transformation. So whenever you involve a middle party in your transactions, rate fixation is never a benefit because middle party is not in a position to fix rates. So one is wrong. And when one is wrong, option A, B, and D gets over. 2 and 3 are the answer. I would advise you for this question, just go to the financial management function chapter and go through it. It's clearly mentioned what are the benefits of financial intermediary when a middle party gets involved. So risk pooling, maturity, they're all written. Okay, obviously we don't have so much time that we discuss all of the topics here. But whenever you involve a middle party in your transactions, that is intermediation, there is no benefit like the fixed rates for you. This doesn't happen. So one is wrong. When one is wrong, option A, B, D gets over. 2 and 3, the correct answer. Okay, now one MCQ relating to working capital management, clearly mentioning which two of the following statements concerning working capital management are correct. I am pausing for 2 minutes. Attempt it on your own. It's a very easy question, specifically my students who have studied working capital management from us. You can easily answer that. Which two statements are correct? Okay, so almost everyone got it right. Which two of the following statements concerning working capital are correct? The twin objectives of working capital management are profitability and liquidity. Told you 50 times in my classes that there are two objectives of working capital management, profitability and liquidity. Repeated every time. The twin objectives are profitability and liquidity. This is correct. A conservative approach. Conservative means a feared approach. You are feared, afraid of something. So you're not aggressive, you're conservative, fearing, afraid. A conservative approach will increase profitability. No, when you are afraid, you work in fear, you lose profitability. You don't increase profitability. Sir, I didn't understand this point. Leave it. You will still get the answer. Working capital management is a key factor in companies' long-term success. Didn't understand it. The current ratio is the measure of profitability. 100% wrong. Current ratio is a measure of liquidity. It's not a measure of profitability. So D is wrong. Okay. D is wrong. Current ratio is a measure of profitability is wrong. Conservative approach and afraid approach, when you're fearful, it will increase profitability. No, it decreases profitability. Aggressive approach increases profitability. So working capital management is a key factor in long-term success. Yes, working capital management is important for long-term success. 1 and 3 are the answers, as many told me. Okay, governments have a number of economic targets as part of their monetary policy. Which two of the following targets relate to monetary policy? I have taught you monetary policy, fiscal policy, exchange rate policy, green policy, competition policy. So which two relate to monetary policy? If you know that what is the role of monetary policy, what is the role of fiscal policy, what is the role of exchange rate policy, you can easily answer it. Which two are targets of monetary policy? Increasing tax revenue, controlling growth rates in size of money supply, reducing public expenditure, keeping interest rates low. As we know, obviously, monetary policy is concerned with interest rates. You click this. But what is the other one? It's asking which two. I have taught you that this taxation, government income, and public expenditure, they relate to fiscal policy. Tax revenue, government income, and public expenditure, government expense, related to fiscal policy. So money supply and interest rates would likely to be monetary policy. Okay. So I have covered 15 more MCQs with you. Okay. And hope you clearly understood all these MCQs. Okay. We will be ending it now.